I wouldn't be surprised if we all find out very quickly that the Federal Reserve got it wrong. They're behind the eight ball on cutting rates, although I'm not in favor of lower rates. I think that the job market was probably a disaster zone very, very earlier this year, and the Fed didn't catch it. Number two, we're probably going to learn in hindsight that the stock markets have it wrong, and their continued run up at all-time highs could very well be misplaced as the Fed starts to cut rates. Go back and look at the cycle in late 2007 after the Fed started cutting rates in September, October, and what happened to the S&P 500. But you know what? Gold seems to be getting it right. Gold's been going up consistently. Seems like $30, $40 a day. I think gold was up another $35 again today, marching towards $3,700 an ounce. Silver up close to $43 an ounce. The 10-year bond is getting it right, sitting just above 4%. That's probably going to come down with our rate cut Wednesday. So a pretty well-known economist from Moody's is out on a Business Insider story today, sounding the alarm bell relative to the economy. Before I jump into the story, I want to give you guys a very heartfelt thank you for all of the comments that you left me yesterday and today ongoing in response to yesterday's video I did where I shared some personal things right now, a couple of struggles, mainly moving my daughter away to college this week and how it's kind of hitting me hard. I spent last night about an hour and a half. I got through at that time about half the comments. I did respond to as many as I could. Many of those comments, literally brought me to tears. So I want to tell you that it's important. It was important to me that you shared those stories and those things because it's a lot of what I'm going through now. Many of you have already gone through, and you've held those thoughts and memories, I can tell, for a very long time, years after your kids have even left college and gone on to be productive adults. But again, thank you. I'm going to get through all of the comments, the rest of them throughout the day, tonight, this evening when I get home, and I'll respond. Okay, so with that being said, if you appreciate the content, please subscribe to the channel. We are growing this community. Let me jump into the article from Business Insider. It says, Moody's analyst Zandi, his name is, I think it's Mark Zandi. Yeah, Mark Zandi, he gets quoted quite often from Moody's. He said that the risk now of the U.S. entering recession in the next 12 months is 48%. It's less than 50%, but he says historically the probability has never gotten this high and a recession not ensued. So to rephrase that, they've never had a 48% probability of recession in the United States, and a recession was avoided. It's always unfolded. Now, I'm sure most of you are going to say, look, that's pathetic. We're already in a recession. Maybe even some would say we're in a depression. But understand the official definition of recession and what the government's going to admit to being a recession, which reverberates certain panic thoughts through all markets, is going to be something different than we all know is unfolding and going on the ground in our everyday lives. What we're seeing, in the jobs market, and layoffs, all those kind of things. So to support this, Zandi provided further data on, this is very interesting, the residential building permits. And what he says, in August, he said the U.S. economy, in August, he said the U.S. economy was on the precipice of recession, and then thereafter spoke with Business Insider. He reiterated his call, noting the economy is at the edge of a cliff. Newest prediction over the weekend, his most dire. And he shared his latest take on concerning economic data in a series of X posts. But what he says is, while building permits have been identified as the most critical economic variable for predicting U.S. recessions, they have held up until now. But he said the number of unsold homes is rising. We've shared that over the last couple of months due to weak buyer demand. That's caused builders to scale back, okay? And permits are forward-looking, right? As Andy noted, this has pushed new permits close to pandemic era lows. How often do we have to go back and discuss and, let's say, compare where we're at now to pandemic era times, pandemic era levels? He added that August permit data is due to be released on Wednesday, September 17th. That's the same day as the Federal Reserve is going to make its rate decision. They're sure to provide, he said, another reason why the Fed should and will announce a rate cut later that day, as Andy predicted. But the markets and a lot of these economists, I'm not an economist, I'm a layperson, love to get your thoughts and input on this. A lot of these economists, whether they're mainstream or what have you, really, I think, believe that rate cuts, and they're saying more and more now the odds are going to be an aggressive rate cut cycle, maybe 3 this year, are going to solve, they're going to be the panacea to solve the problem. And I'm not so sure about that, right? Because what happens when these rate cuts start unfolding? We've discussed how this is not going to obviously and immediately unlock the frozen housing market. People aren't going to be able to, or not going to be wanting to go out automatically and replace their low mortgage at 3% or 4% with a mortgage at 5 or 6%, even if rates are coming down. It's just not, it doesn't make sense. We know credit scores are at an all-time low right now. We know consumer defaults are hitting, all-time, highs. Bankruptcies are on the rise. So what is this going to really do? It's going to help the federal government service its interest on its, $37 trillion of debt. We discussed that in, I think, Friday's video. Other than helping the government and helping maybe people with massive credit card debt to save a couple $100 a month on their credit cards, it's not going to free up more credit. It's not going to give them better jobs and higher income and better W-2s to support, going out and getting a mortgage at 5 or 6%. So what happens in let's say, in a defined recession? Job losses rise, layoffs and reduced hiring hit first in cyclical industries, construction, retail, hospitality, right? Wage growth slows or reverses, raises, bonuses, and overtime pay dry up. More part-time underemployment, employers cut hours before cutting staff entirely. We've already seen that happen now. Spending and consumption. Consumers cut back further. Non-essentials like travel, dining, luxury goods, and big-ticket items see massive drops. We are a consumer-based economy, right? The biggest contributor to GDP is people going out to restaurants, taking trips, going out and buying, fancy shoes and handbags and things of that nature. Shift to cheaper substitutes, private label groceries, used cars, discount retailers, and chain stores. Delayed purchases. People defer even more purchasing of cars, appliances, and improvement for their homes. That's already unfolding now. This is a big one. You have further rising defaults on credit card, auto, and personal loan delinquencies, and credit dries up. It's harder to borrow money, okay? Banks do not lend money as freely, and they make tighter lending standards at a time when people's credit score is getting worse, at a time when they're carrying more debt and need loan relief in some respects. Look, and understand, if you have bad credit, you can't even go and borrow the equity from your own home, okay? If you guys don't understand that, please do some research on it. So banks tighten credit standards, reduce limits, and raise risk premiums. Households with high leverage are forced to cut spending the most. Home values stagnate. And look, it'll happen even more than it is now. Depending on severity, housing markets cool sharply, right? So all these all-time high housing prices you've seen will come back. We also have foreclosures that will rise because you've got consumers already stretched very thin. They lose a job, if their hours get cut, if their bonuses get cut, they can't pay their mortgage anymore, okay? And rent demand can increase if ownership continues to stay unaffordable or people are forced to endure foreclosure and then become renters, okay? And of course, fear dominates, takes over, and affects stock markets. Don't forget, bottom line for all these corporations gets hit hard because people aren't spending. Therefore, the corporations are not making their revenue predictions. Their share prices fall, and that becomes, a downward spiral, kind of a doom loop. So that's what we're looking at, really, as a extension of what Mark Zandi has laid out now. Let's see if it happens. Let's see if the Fed can pull a rabbit out of a hat and aggressively come in and somehow stave all this off. I don't see it happening. I want to get your thoughts and your comments. I just think it's probably a little too late. The Fed always seems to play catch up, catching up from behind. And, all I can tell you guys, we discuss this all the time on the show, is do your absolute best to fortify your income positions. If you have a strong job, keep it for a while. The old days of take this job and shove it are kind of gone now. Stay put, do the best you can. Try to get a side hustle going for some much additional income as you can get coming in, and just keep paying off that debt. Make a game plan, do it smart. Be careful with buying new stuff right now, and let's see how this unfolds. Okay, markets are going to be reacting to this. If you're in the market heavy, everyone's gambling that's only going to have one way to go, and that's going to be up because of rate cuts. My take is the only thing that's going to go up right now for sure is gold. And you might see cryptos also deleverage from the overall, let's say, NASDAQ and start following up as well as a preferred asset. So leave me your thoughts. Thanks for subscribing to the channel. If you enjoy the content, give me a like on the video. With that being said, I'll talk to you all soon. Bye.